Hi everyone, I am going to try something new today. I'm going to use my whiteboard to help me to illustrate what I want to talk about today. I think one of the biggest questions that I get asked very often is how to calculate your capital gain tax. And when you sell a rental property. Now, when I have to give a really big disclaimer here. This is a high level, quick and easy, dirty way of calculating, estimating your tax. It is based on a lot of assumption, and it helps you to determine or estimate an amount to set aside before you spend them all on your next cruise or a cottage or anything that you cannot deduct. So now here is the example. Let's go into the detail. Let's say you purchase a property for $300,000 and you eventually sell it in year 5 for 500,000. So technically, you made a $200,000 gain on the profit from the property, and that $200,000, because in Canada you get 50% exemption. So that just means that when you sell a property, only 50% of the capital gain would be taxable. So when you take the 50% of the capital gain that's taxable, only $100,000 is being taxed. 100,000, even though you make $200,000, you really only pay add to your income for $100,000. And out of the $100,000, if we take the highest personal marginal tax rate in Ontario today, which is 54%, 53.5%, I think. And I round it down to 50%. It's for easy calculation. Remember, it's a rough estimate. So it's $100,000. You take the taxable capital gain, multiplied by your marginal rate, which is 50%, and so your capital gain is 50,000. Capital gain tax is $50,000 that you have to set aside. Now, there is a second component to your calculation, to your estimate. The second component is something called recapture. The reason why there is something called recapture is that you are allowed, as a real estate investor, you are allowed to claim capital. You're allowed to claim something called capital cost allowance against your rental income to defer the taxes until the year that you sell. But when you sell, all these years of deferral, which we call it capital cost allowance, would have to be added back to your income when you sell the property. And when you add it back to the income, that add back is called recapture. Now, let's say in year 1 you didn't claim any of the capital cost allowance. Year 2 you claim $2,000. Year 3 you claim $3,000, and year 4 is $1,000. Throughout the years, you have claimed a total of $6,000 of capital cost allowance, and this $6,000 is now the recapture amount, and you will have to add it back to your income. Now, this is not the same as capital gain here, because essentially, if you did not claim the capital allowance, that $2,000, $3,000, and $1,000 would be added to your income as your regular income. And so this $6,000 is taxed as your regular income. There is no 50% inclusion rate. It's always taxed as income, 100% of it. Now, but assuming your tax rate is at 50%, then 6,000 multiplied by 50%, that is $3,000 on all the recapture tax. Now, in my particular example, $50,000 from the capital gain, $3,000 from the recapture tax, so a total of $53,000. Now, I know not all of us are paying at the highest marginal tax rate, but and some of you guys are owning the properties in the corporation. If that's the case, 50% is still a really good estimating point, starting point for you to estimate your capital gain tax. It's just because anyone that's making over $100,000, any additional income is already being taxed at 46%, 43% and up. So to budget 50% from your gain and to purchase more property, to set aside the money for CLA at year end is a pretty accurate number. And it's better to save more than less to give yourself a little bit of a cushion. Until next time, happy Canadian investing.